All right, stop scrolling for a second because something important just happened in silver and it's happening fast. We're talking about a metal that was smashed down to roughly $71 just days ago, now ripping back to around 90 in Western markets, while Shanghai is trading near 104. That's a $14 to $15 premium, about 16%, and that gap doesn't exist by accident. This is price discovery waking up in real time. CME margin hikes flushed leverage last week, forced sellers puked positions, and now that pressure's fading. Buyers are stepping back in aggressively. If you care about recognizing explosive setups before they go mainstream, stay with me, because I'm going to walk you through exactly what's unfolding and how to spot it next time. Before I explain what caused this, let me teach you something most people never really internalize about markets. Price doesn't move because of opinions. It moves because of positioning and pressure. Think of the market like a crowded elevator. When everyone's leaning the same way, it only takes a small jolt for people to stumble. In silver, leverage is that crowding. When margin requirements jump, that elevator lurches. People don't sell because they want to. They sell because they have to. That's what we saw last week, and here's the key lesson for you. Once forced selling exhausts itself, the market often snaps back harder than anyone expects, because the selling pressure wasn't emotional, it was mechanical. Now let me break that down a bit more because this is the foundation for understanding what happens next. When you hear the term forced liquidation, what that really means is people running out of options. They're not making a choice based on fundamentals or news or some analyst report. They're getting a margin call. Their broker's saying, hey, you need to post more cash or we're closing your position. And when you've got thousands of traders in that same boat at the same time, you get what's called cascading pressure. One person sells, price drops, that triggers another margin call, more selling, more dropping. It feeds on itself. That's the elevator analogy in action. But here's what's critical. That kind of selling has a natural endpoint. Eventually, everyone who had to sell has sold. There's no more weak hands left to shake out. And that's when things get interesting, because the market doesn't just stop. It reverses. Why? Because the same people who were forced out, or new buyers watching from the sidelines, they see value. They see an opportunity. And when they start stepping in, there's no resistance on the other side anymore. The sellers are gone. So price doesn't drift higher. It snaps. It moves fast. And if you're not watching for that pattern, you miss it entirely. So what does that tell us? It tells us that markets are systems of pressure, not systems of value. Value matters, don't get me wrong. But in the short term, what moves price is who's forced to do what and when. If you can identify when forced selling is happening and when it's exhausting itself, you've got a massive edge. You're not guessing. You're reading the mechanics. And that's exactly what we're seeing in silver right now. Now here's what's actually happening. Let me break down the sequence. First, CME raises margins. That instantly increases the cost of holding leveraged futures. Weak hands get pushed out. Silver drops hard, down near 71. Shorts get emboldened because it feels like the breakdown is real. They pile in, thinking they're riding the collapse. Second, that selling pressure runs out of fuel. There's no one left who has to sell. At the same time, physical demand never went away. You can see that clearly in Shanghai, where spot prices are hovering around 104. That persistent premium is the market screaming that real metal is scarce. So when futures start ticking higher again, Western prices get pulled up toward that physical reality. Futures volume expands, momentum traders re-enter, and suddenly you're up 25% in days. But here's the part that should make you nervous if you're not paying attention. When shorts press into what they think is weakness and the market turns, that reversal can turn into a squeeze very quickly. And I mean very quickly. Let me explain why that happens. When you're short silver, you're betting the price goes down. You've sold contracts you don't own, planning to buy them back cheaper later. But if price starts rising instead, you're losing money. And here's the kicker. Your losses are theoretically unlimited. So what do? You cover. You buy back those contracts to stop the bleeding. But when a bunch of shorts do that at the same time, they're all buying. And that buying pushes price higher, which triggers more shorts to panic and cover, which pushes price even higher. It's the same cascading effect, just in reverse. That's a short squeeze, and it's violent. Now, let's talk about that Shanghai premium, because this is where the physical reality validates what's happening in the paper markets. When Shanghai's trading at 104 and New York's at 90, that's not noise, that's information. What it's telling you is that people who actually need physical silver, manufacturers, industrial users, investors who want delivery, they're willing to pay 104. They can't get it cheaper. The metal isn't there, or it's tied up, or it's moving too slowly. Whatever the reason, the premium exists because supply is tight. And here's what happens when that premium persists. Arbitrage should close it, right? Traders should buy in New York at 90, ship it to Shanghai, sell at 104, pocket the difference. But if that's not happening fast enough, or if there are barriers like export restrictions or logistics or just physical availability, the premium stays. And eventually the paper price has to acknowledge the physical price. It has to converge. Because at the end of the day, futures contracts represent claims on real metal. If the real metal's trading at 104, futures can't stay at 90 forever. The gap closes. And when it closes, Western prices rise. So what we're seeing right now is that convergence starting to happen. Futures volumes expanding, that's important. Volume tells you conviction. When volume's rising with price, it means money's flowing in, real money, not just a few speculators. And when you combine rising volume with a persistent physical premium and the exhaustion of forced selling, you've got all three ingredients for a significant move. That's not hype, that's mechanics. This is the exact same playbook we've seen before. Every time this setup appears, the rhythm is eerily familiar. Look back to 2011. After a violent correction flushed leverage, silver didn't drift higher. It surged. It overshot what anyone thought was reasonable. I remember watching it in real time. People were calling for $30. It blew through 40, hit nearly 50. Why? Because once the forced sellers were gone and momentum kicked in, there was nothing to stop it. The physical buyers were there. The industrial demand was there. And the shorts got caught. Zoom out to March 2020. Same story. Panic selling. Margin calls. Liquidity drying up. Silver dropped from $18 to $11 in a matter of days. Everyone thought the world was ending. But what happened next? A sharp, multi-day rebound. Within weeks, it was back to 18. Within months, it was pushing toward 30. Again, the pattern held. Forced selling exhausted itself. Physical demand never disappeared. And when the pressure flipped, price moved fast. And if you want to go even further back, look at late 2015 into early 2016. Silver bottomed around $13.50 after a brutal multi-year bear market. Sentiment was terrible. No one wanted to touch it. But then quietly, physical buying started picking up. Industrial demand stabilized, and in the first 6 months of 2016, silver rallied from $13.50 to over $21. That's more than 50%. Not because fundamentals suddenly changed overnight, but because positioning reset. The sellers were exhausted, the buyers had room to operate, and the market repriced. When you look at the pattern, it's not about predicting tops or bottoms. It's about recognizing when structure resets. And what I mean by structure is the balance between buyers and sellers, between leverage and physical, between paper claims and real metal. When that structure gets too lopsided, when everyone's leaning one way, a reset is inevitable. It might be forced by margin hikes. It might be triggered by a geopolitical event. It might just be exhaustion. But it happens. And when it does, the move that follows is usually bigger and faster than people expect. The larger story here is that price discovery phases don't move politely. They move in bursts. And those bursts tend to surprise people who are anchored to yesterday's price. If you're sitting there thinking silver's a $70 metal because that's where it was last week, you're already behind. The market's telling you it's not. Shanghai is telling you it's not. Futures volume's telling you it's not. You've got to adjust your framework in real time, or you get run over. Now, let me be skeptical for a moment because you should be too. Could this fail? Absolutely. Shanghai premiums can compress. Maybe there's a sudden release of physical supply. Maybe Chinese demand weakens. Maybe the premium was artificial or temporary. If that happens, the thesis breaks. Futures momentum can stall. If 90 doesn't hold as support, if we get a breakdown below 85 with heavy volume, this whole narrative changes. You've got to be willing to pivot. And here's the thing about manipulation claims. Yes, silver's a heavily managed market. The big banks have been fined for spoofing. There are documented cases of price suppression. I'm not denying that. But manipulation doesn't negate mechanics. It operates within them. You can't manipulate a market that has no physical supply. You can't suppress a price when industrial users are desperate for metal. At some point, reality asserts itself. So instead of arguing about villains, focus on what you can control. Watch price, watch volume, watch spreads. If the Shanghai premium collapses, if it goes from $14 to $2 overnight, that's a red flag. If futures volume dries up, if we're seeing price rise on thin participation, that's a warning sign. If open interest starts declining while price is rising, that could indicate short covering without new longs entering, which means the move might be temporary. Simple as that. You don't need to know who's pulling the strings. You need to know what the data's telling you. Could this be another head fake? Could the big players be running stops before slamming it back down? Maybe. It's happened before. But again, that's why you watch the signals. If 90 breaks and holds, that's confirmation. If it breaks and fails, that's invalidation. You don't marry your position. You marry your process. And the process says stay flexible, stay data-driven, and don't let hope or fear override what's actually happening on the chart. There are probably 3 types of people watching this right now. First, you might already be long silver. Maybe you've been holding physical for years. Maybe you bought futures at 75 and you're feeling pretty good right now. If that's you, I get it. That rush is real. But your job isn't to get euphoric. It's to manage risk. Ask yourself, where am I wrong? If price breaks below, what level do I have to reassess? What's my exit strategy if this reverses? Because the worst thing you can do is ride it all the way up and then all the way back down because you couldn't admit when the setup changed. Second, you might be on the sidelines. You're watching this move happen. You're skeptical. You're thinking, man, I missed it. It already went from 71 to 90. It's too late. If that's you, let me tell you something. This isn't about chasing candles. It's about waiting for confirmation. If 90 holds as support on a pullback, that's your entry signal. If price pushes through 95 with expanding volume, that's confirmation. You don't need to catch the bottom. You need to catch the trend. And trends give you multiple chances to enter if you're patient and disciplined. Third, you might be bearish. You're convinced this is another pump before the dump. You're thinking the manipulation's just setting up retail to get wrecked again. That's a valid view. I'm not going to tell you you're wrong, but make sure it's grounded in data, not frustration. If you're bearish, fine. But what's your thesis? Is it based on technicals? Is it based on fundamentals? Or is it based on the fact that you've been burned before and you don't trust the market? Because one of those is analysis. The other two are emotional, and the market doesn't care about your emotions. For all of you, the universal principle is the same. Markets reward those who react to evidence, not those who cling to narratives. If you're bullish and the data turns bearish, you flip. If you're bearish and the data turns bullish, you flip. Your ego doesn't matter. Your past losses don't matter. What matters is what the market's doing right now. And right now, the market's showing strength after a forced liquidation event. That's the evidence. What you do with it is up to you. So here's where I stand. I'm not blindly bullish, and I'm definitely not panicking. I'm watching three things closely. First, does 90 hold as support on pullbacks? If we get a dip back to 90 or 92 and buyers step in aggressively, that tells me the floor is real. That tells me there's demand at that level. If we slice through 90 on volume, that tells me I was wrong and I need to reassess. Second, do we get a clean momentum trigger through 95 with expanding futures volume? 95 is a psychological level. It's also a technical level if you look at prior resistance. If price breaks through 95 and volume confirms it, that's a sign that this isn't just short covering. That's new money entering. That's bulls taking control. And if that happens, 100 becomes the next magnet. Not because it's a round number, although that helps, but because it aligns with where Shanghai's already trading. Third, does Shanghai stay above 100? If Shanghai pulls back to 98 or 95, the premium compresses and the thesis weakens. But if Shanghai holds 100 or pushes higher, that tells me physical demand is real and persistent. That tells me the supply tightness isn't going away. And if Western prices are going to converge with Eastern prices, they've got more room to run. If those three line up, if 90 holds, if 95 breaks with volume, if Shanghai stays elevated, 100 becomes less of a dream and more of a magnet. Could happen this week, could happen next week. I'm not making a time prediction because markets don't operate on my schedule. But the setup's there. The ingredients are aligning. And if history rhymes, the move isn't done yet. The way I see it, last week's crash was mechanical, not fundamental. It was a margin hike forcing liquidations. It wasn't a collapse in demand. It wasn't a discovery of massive new supply. It was a technical reset. And when technical resets happen in the context of strong underlying fundamentals, the bounce is usually legitimate. The fundamentals here are actually validating demand. Industrial users need silver for solar panels, for electronics, for EV components. Investment demand's picking up. Central banks are diversifying away from dollars. None of that changed because CME raised margins. So what we're seeing is the market digesting a forced seller event and then repricing based on actual supply and demand. That's healthy. That's normal. And if you understand that dynamic, you're not surprised by 25% moves in a week. You're expecting them. You're positioned for them. Or at the very least, you're not caught off guard. Now, I'm not a financial advisor. This is not financial advice. I'm sharing my analysis, my process, my observations. You need to do your own research. You need to verify everything I'm saying. You need to make your own decisions based on your own risk tolerance and your own financial situation. Don't take my word for anything. Go look at the charts. Go check the Shanghai premium yourself. Go read the CME margin announcements. Build your own conviction. Because when the market moves, and it will move, you need to be confident in your own analysis, not relying on some voice on the internet. If you made it this far, you're the kind of person who wants to understand, not just react. That mentality will serve you well. The people who make money in markets aren't the ones with the hottest tips or the best insider info. They're the ones who understand mechanics. They're the ones who can read pressure and positioning. They're the ones who stay calm when everyone else is panicking and stay skeptical when everyone else is euphoric. If this analysis helped you see something you weren't seeing before, do me a favor. Share this video, drop it in your trading groups, send it to someone who's trying to figure out what's happening in silver right now. The more people who understand these patterns, the better conversations we can have. And hit that subscribe button if you want more of this kind of breakdown, because I'm going to keep tracking this market and sharing what I'm seeing. Stay sharp out there. Think critically, verify your data, and make your own decisions. I'll see you in the next one.